to resolve and is now being investigated by the federal government. Tesla is increasing the price of its most popular Model Y sport utility vehicle. All three of its Model Y variants are now $1,000 more expensive. The hike was widely telegraphed for several weeks, and China's automakers are piling in to take advantage, offering sweeteners such as subsidies and coupons to attract potential buyers. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, a patient, Chair Powell.
Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut.
What's the rush on the FOMC? That question up next, live from New York City. This is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Live from New York City, equities bouncing back just a little bit to start the quarter, up by 0.4%, adding some weight to the recent equity market rally of more than 10%, double-digit gains for Q1. Single name, let's check in on BYD. BYD unit sales, vehicle sales up 46% year on year. The growth here is just phenomenal, up 56% for plug-in hybrids over at BYD. And AMH, this is where the competition is right now in a major way.
Absolutely, and it's why you see the United States potentially adding more, and they're undergoing potentially not allowing China's vehicles to come in. They'll say part of this is national security, but also is the fact that they want to make sure that they can have their own automakers competitive in the United States and China. 25% tariff for a Chinese vehicle to get into the United States. But Jonathan, look at these numbers that's happening in China, and it's why you see all the other automakers having to cut prices just to remain competitive.
Quick snapshot of analyst recommendations on the name: 38 buys, 1 hold, and just 1 sell. Under surveillance this morning, a patient, Chair Powell.
The economy is strong. We see very strong growth. We had growth for last year over 3%. Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut. It means we can wait and become more confident that, in fact, inflation is coming down to 2% on a sustainable basis.
Here's the latest this morning. Core PCE, the Fed's preferred measure of inflation, cooling in February, reinforcing bets the central bank will cut rates later this year. We'll hear again from Powell on Wednesday ahead of US payrolls on Friday. Mike McKee, our economics and policy correspondent, joins us around the table. So, Mike, you were in on Friday. You drew the short straw.
Yeah.
Any big changes on the data going into the weekend?
No big changes on the data. Jay Powell had told us that the core rate would probably come in about 0.3%, and it did a little below that as he forecast, and then it's rounded up to 3. But basically, what we're seeing is inflation is continuing to come down, but it has slowed its progression, and that's what the Fed is looking at. Powell was asked, why don't you cut anyway? And he basically said, we don't want to move the markets around. We don't want a lot of volatility. We want to be safe. We want people to think that we're moving in the right direction at the right time. We're going to be careful. And so he just justified it with the part you just heard about how the economy is strong. They don't need to cut right now.
We were talking to Laurie earlier in the hour about the boom we saw in January, waiting to see if February confirmed that or not. It didn't really. Ian Shepperson of Pantheon Macroeconomics saying the spike in January was a one-off. It was a one-off fluke. Is that how you'd characterize it?
No, at this point, it's, yes, a fluke in terms of that extra added, but we're still seeing strength. We're seeing strength in hiring. It's over 200,000 each month. We're seeing strength in spending. The PCE spending numbers came in up 0.8, which was a sort of phenomenal turnaround from January. So we're seeing the U.S. economy running ahead of potential growth, which is a warning flag for a Fed that's still worried about inflation.
I would say, the question John asked me earlier about employment versus inflation in terms of the stats, what do you think are more important in the next couple weeks?
Inflation, I think, is what the Fed is really looking at. The jobs numbers will add to an impression one way or another of how strong the economy is, but there's going to be a lot of data on that for them to absorb, where the inflation numbers are an actual target. Yeah. That's what they've been looking at. And I think that's what the markets will look at and push in the direction of, depending on how the inflation data.
So one thing that's come up repeatedly in the communication of Chairman Powell, which is why I think a lot of people are asking that question that Laurie just mentioned, is there seems to be this emphasis on the labour market, and if it weakens, we'll be ready to respond. What do you make of that shift, if we can indeed call it a shift?
I don't know if it's a shift so much as the Fed, it's an insurance statement. Like, if we are all focused on cutting rates, the market totally focused on cutting rates. If we had a situation where the economy was going into a recession, then we would cut rates much faster. And what he's doing is avoiding using the word recession by talking about the labor market.
Powell on Friday also talked about dividing their critics into now equal-sized parts, basically saying those who think we should cut or those who think we should maybe stay the same or hike. If that's where you are, then wouldn't that show that the Fed is actually at a perfect position?
It should. But, of course, everybody on Wall Street is never satisfied with where the Fed is. It's always the Fed's fault. I never made a bad trade. It's the Fed's fault. And so you do have half the people thinking that the Fed needs to cut, half the people thinking the Fed needs to raise, and you can see that play out on X and the other social medias feeds. And so for the Fed, they do feel kind of like they're in a good position because the economy is strong. But inflation is still going down at this point.
Anne-Marie mentioned the distance between Governor Waller and Chairman Powell perhaps narrowing. What do you make of that? What is the distance between the likes of Governor Waller and maybe President Bostic and the rest of the committee?
Well, I think basically everybody's sort of moving in that direction. The idea that the economy is stronger than they had anticipated is pushing people. We saw with the dot plot that came out in March that a number of people had moved up, and they were not going to be willing to cut. It would only take one more person to change, and you'd have the two dots. So I think if the economy continues along this path, and we have no guarantee it will, that you probably in June would see a dot plot. And then the markets have to recalibrate everything again.
I do wonder, Laurie, just to finish up with you, how different would the conversation have been the other week if we did get the median dot shifting from 3 to 2? Because we were only that far away. We were pretty close to that happening.
Yeah, look, I don't think it would have necessarily been enough to prick this sentiment bubble, our bubblet that we've got there right now, but I think maybe it could have dampened the enthusiasm just a little bit. We have run some numbers, sort of looking at the Fed SEP, or even just keeping inflation sticky and no cuts from the Fed. And if we run our valuation model through that stress test, we get to an S&P of like 4,950 to 5,100. So I don't think it would do, if we just take them all out, I don't think it kills the market, to be honest. But it could, kind of flatten us for a bit.
You mentioned the B word, then backtracked a little bit. Can I just bring up that B word, bubble and bubblet?
Yeah.
What's the difference between the two?
Look, I think when you go back to this Mag 7 conversation, is it irrational exuberance? I started in this business back in 2000. It's not silly like that. I mean, look, these companies had the earnings to back up the premium valuations. Those earnings are decelerating. That earnings growth advantage is decelerating. There's less of a rationality to pay that premium multiple, but this is not a stupid market by any stretch.
This equity market has ripped to start the year. Mike, good to see you. Mike McKee breaking down the economy and Chairman Powell. Laurie, thank you for the last hour. Thank you very much. Laurie Cavacina of RBC Capital Markets. Coming up in the next hour of Bloomberg, we'll catch up with Jake Poloski of TTPW Advisory. He'll be with us around a table for the next 60 minutes or so. We'll speak to Lee Klasko of Bloomberg Intelligence, Norman Rule of CSIS, and Ed Al-Husseini of Columbia Threadneedle. Norman Rule, got to talk to him about the potential, Anne-Marie, that Israel makes a move into Rafah in the next few weeks.
And potentially get an update on that, because Axios is reporting that Israeli officials will be speaking to the Biden administration today. And what we've heard from the White House is that if they go in, it's the way they go in that matters.
That conversation just around the corner. Equity futures right now on the S&P 500, adding to the rally, closing out Q1 at all-time highs and looking to add to it here in Q2. Live from New York City, the second hour of Bloomberg Surveillance. Up next.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Chair
Powell will have some communication challenges ahead.
They have a communication issue right now. They're going to have a tough time navigating this because the markets are really dependent on them being dovish.
It's possible that they start to cut and the economy just reaccelerates a little bit.
Our first rate cuts are probably in September.
We're leaning on June for the first rate cut.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Leaving behind solid gains in Q1, welcome to Q2. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. The second hour begins right now. Alongside Anne-Marie Hordern, I'm Jonathan Ferro, joined together this morning by Jay Pawlowski of TPW Advisory with us through the next 60 minutes or so. If you are starved for Fed speak this week, you are not going to be on a diet, that's for sure. Look at this lineup. Williams, Mester, Daly, tomorrow, Wednesday, Goolsby, Powell, Thursday, Harker, Barkin, Goolsby, Mester, Barkin again on Friday, and a whole lot more. Friday morning, the big one. It's payrolls Friday, the estimate, 200K. Your equity market on the S&P 500. On the first trading day of April, equities look like this. Futures positive by 0.4% after closing out Q1 at all-time highs. In the bond market, your 10-year 420.82. Plenty to talk about this hour. We'll catch up with Lee Klasko of Bloomberg Intelligence as ports on the East Coast scramble to absorb cargo. We'll catch up with Norman Rule of CSIS. With Axios reporting the US and Israel will hold a virtual meeting today, and Ed Al-Husseini of Columbia Threadneedle on why he likes long-end bonds. We begin with our top story, kicking off the second quarter following 5 months of gains on the S&P 500. Jay Pawlowski of TPW Advisory thinks the rally can extend, writing this: we are optimistic not only about 24, but the out years as well, 25, 26. Our analog remains the US 1995 to 1999 period. The difference is this time it's global. Jay joins us right now. Jay, good morning to you.
Good morning, John.
Does the economic data in China back some of that up this morning?
It sure does, John. I mean, I think it's clear to us at least that, and it's not only the data, right? We wrote a piece on Friday, our Friday musings, called Listen to Stocks, Not Vox. And we want to pay attention to what the markets are telling us. And it's not just stocks. It's also credit outperforming the ag, and it's commodities. And commodities, I think, right now are the big tell. Commodities, and it's not just energy. It's not just gold. It's not just copper. It's all of it. It's ag. It's all breaking out. And that is telling us that there is an opportunity and that the global economy, as we've been saying since the fall, is early cycle.
Soft commodities as well, seen it in cocoa. But
absolutely.
A lot of people might say that's a supply side story, not demand. How would you frame it?
I would frame it as both, and that's perfect. It's both supply side as well as demand side. And the fact is that most people have not been investing in commodities, and the demand has been weak, and they've been okay. And now we're coming into a point where that lack of investment, which can't be made up quickly, is going to bite. At the same time as a global economy, we think is setting up for a considerable period of good economic news. And that combination and the fact that very few people are invested there, very few people understand that commodities are the best performing asset class in the world year to date. Everyone wants to talk Mag 7. Mag 7, Mag 6, Mag 5. Commodities, people, it's really basic. It's supply and demand. You don't have to figure out AI. It's just simply buying the stuff that people still use.
How much does hinge on China, though?
Obviously not very much, because China has been a weak story, and commodities have done well. Markets move first. That's the thing that we have to remember. They're forward-looking discounting mechanisms. They know more than you, me, even you, John.
I'm shocked.
And therefore, they move first. And so commodities are, world's best performing asset class, when now people are just starting to think about China. Okay, PMI is better than expected. JP Morgan last week raised their Q1 GDP estimate to 6.6%. Okay, so you're talking about second biggest economy in the world, looking like it's starting to pick up, and that is obviously bullish for lots of things, including commodities.
A phrase we heard repeatedly, I think, over the last year regarding that region, that part of the world, was uninvestable. And I guess the caveat around that is it depends what you're investing in to get exposure to it. There's a great quote in your recent note, and I'm going to share it with our audience, and I want your thoughts on it. We note the discrepancy between the China tech stack, one that will increasingly have all of China to dominate. That's a really important line. Can you just build that out a little bit more?
Yeah, first off, on that uninvestable line, I also wrote a couple months ago, pro tip, when you hear uninvestable, invest. So that's point A, because it can't get any worse. Can't get any worse than uninvestable. But yeah, I think this point about the tech stack is really, really interesting. There are a lot of things setting up to create a big opportunity. And let's remember that markets have already moved in the US, in tech, et cetera. So we want to be looking for the new areas of opportunity. And that's why that multi-year positive framework allows us to go from point A to point B to point C, et cetera. And that's what we've been doing in our model portfolios. The tech stack story, look, we've been trying to freeze China out of the advanced technology. We're doing a pretty good job. They've got the message. They have to build their own. They're now turning around saying, okay, fine, you can't play in our tech space. And therefore, the question is right now, do you want to be invested in a market of 1.4 billion people, growing at 6% per annum, with an e-commerce market that's double the size of the US, 10 times the size of Japan, and trades at a 70% discount? Alibaba trades at 8 times earnings. Tencent trades at 14 times earnings. China overall trades at 9 times earnings. Okay, no one owns it. It's like, I think it's a really interesting story. And the segue, you know, flip your Mag 7 into KWEB, which is the China Tech ETF. KWEB can double and double again and still not get to the level it was in 2021, John. 25 to 50. The 2021 high was $101. I mean, that to me is a no-brainer. And we you know, full disclosure, we own it.
Peter Chi of Academy is going to join us later in the program in the next hour. He's put the emphasis on made by China. How important is that phrase going to be in years to come?
Yeah, I mean, I think we're big believers. Our name and our firm, TPW, stands for Tripolar World. Our whole thesis, our framework is regional integration in the 3 main regions of Asia, Europe, and the Americas. All of this stuff is happening kind of as one would expect. Supply chain regionalization, tech stack, independent development. Everyone needs AI. Everyone needs the climate proof. Everyone needs everyone needs electric vehicles and batteries. And these are the things that are driving that regional integration. And look, I think China is in a much stronger position than people give it credit for, because the region that they're in, that they're going to dominate, is ASEAN. ASEAN is the biggest, fastest growing region and will be for the next 10 years.
It's striking that you have such conviction in China when what we continue to hear from Washington is that they're just going to up the ante. Right now, they're weighing whether or not they're going to sanction the chip makers around Huawei's entire production. How much does that concern you?
Yeah, no, there's a race, right? There's a race going on. China's racing to get itself kind of independent, and we're racing to freeze them out of this stuff. And I think the point that we see is that the U.S. trying to freeze China is already in the price. Everybody who doesn't want to invest in China because they're worried about U.S. sanctions is already gone, long gone. And they're not going to come in. Fine. We don't need them to come in. Again, KWEB can double and double again. I'll just take the first double from 26 to 50 and leave the second double to somebody else.
So a 60% tariff wall for Chinese imports doesn't matter?
Yeah, sure, it will matter. Markets will sell off depending on where we go between now and then.
But I mean, if China is going to build within their own ASEAN.
Yeah. I mean, I would look at what China's done over the last 30 or 40 years, and I don't think we'd want to bet against their ability to kind of construct what they need to construct.
So when everyone else said uninvestable, you got bullish. When you say no-brainer, does that make you uncomfortable? What are the risk factors you would acknowledge exist around this bullish thesis?
For China?
Yeah.
Clearly what Anne-Marie said is one. I mean, if we come out, if the former president wins, which as I've said on this show, I believe Biden will win on the landslide. But if the former president were to win and were to implement the tariff structures that he's talked about, that's clearly going to set the Chinese market back. But by the same token, as we advance to that point in time, China's own internal dynamics theoretically should get better, right? The property market should be better dealt with. The focus on domestic consumption should be moving further down the road. So it's not a zero sum. And how that all plays out, I mean, we have the ability to change our mind and to adjust our positions, and so we'll look at that when the time comes. But I mean, that to me is a big worry, because I think everything else is in the price. Alibaba, and no, it doesn't grow as much as it did before, but as the prior guest said, same is happening in the U.S. tech space. Earnings acceleration is coming down. Same as in Alibaba. The other point is that these companies in China are just like the U.S. companies. They're cash-making machines. They are buying back stock. They are paying dividends. And so, 8, 9 times earnings, I think the risk-reward is some of the best in the world, because the risk is already in the price and the reward is starting to materialize.
I'm sure this morning you've managed to convert a few non-believers for a tactical trade. What's interesting about your call, it's not just tactical, it's not 2024, it's 2025, it's 2026. Why has this been extrapolated out? It doesn't sound like this late cycle story from your standpoint. It feels much, much longer term.
Yeah, exactly, John. And, we put out a piece, our 2024 outlook, back in the beginning of November, so 5 months ago. The title was Surprise, Surprise. We had 4 macro surprises: lower inflation sooner than expected, better productivity growth, return to stability, and early cycle. All those are playing out. In particular, the return to stability argument. Look at the VIX. Look at the move. Look at the Fed. With all respect to the lineup of Fed speakers, I pay virtually no attention to that anymore. That is not the story.
We've just had an 8-minute conversation, and that's how long it took to mention the Federal Reserve in your whole thesis.
Yes, and that's exactly right.
Why is that?
Because it doesn't matter. The important thing is that the Fed and markets are in sync after being out of sync, right? 6 rate cuts in December, now, and Fed at 3. Now we're both at 3. And guess what? That happened without a ripple of market unease. And that tells me that's one of the things that tells me that this market is a strong market. And so we have, in our view, we're early cycle. We've made a return to stability. The Fed is our friend now, right? Can cut, as you were talking about, with labor worries. The Fed is our friend. The rest of the world is picking up. And so we look at 2023 to 2027, that body of time as being very much akin to 1995 to 1999, where you had productivity-inspired growth, you had lower inflation, you had good earnings growth. The difference, as you quoted, is that this time it's global, and it's global because of this tripolar world materializing, and the fact that everybody has to spend on AI, on climate, on semis, on electric vehicles. And so you're getting, in our view, a much more stable globe, because you're not dependent just on the Chinese consumer or on the US. You now have 3 centers that are going to be growing independently of each other. And so the question is, who balances best private and public sector? Because you need both, because these are huge, huge investments, right? These are like, game-changing investments. And so who manages that best? And that's one of the reasons why we like Europe. And you and I have been talking about this for years. But Europe has more experience than any region in getting everybody around the same page. One can argue they didn't do it well and it takes too long. But, look at the U.S. and Congress, right? I mean, no, not really an example of great governance. And look at China, stumbling after a really good run. So I look at ASEAN, and China dominates ASEAN, fastest growing region of the world. We want to play there. We look at Europe integrating, being forced by conflict to integrate, right? Multiple countries spending together, raising debt together, so you're going to see that capital market integration. And then we look here in the Americas and we see Mexico, which again, we've been overweight and invested in for 2 years because it is the flagship for the tripolar world thesis. Biggest beneficiary of what's going on in the Americas. We were invested in Poland. You and I talked about that last time for the European thesis as well.
Yep.
And we're invested in China for the Asian thesis. And so to us, it's an exciting blue sky period ahead. And the fact that most people are not there, people have kind of gotten onto the tactical trade. I mean, 27% in 21 weeks. If you're not on the tactical trade, you're probably not working anymore. But to us, the good news is that we are, we see the process moving for multiple years, and we're still early in that, and others are going to come behind us. We're already double-weighted commodities, and we have been for 6 months. And so we're just moving from point A to point B and onward.
This is some super bullish stuff. Just remind me never to book you for Fed Decision Day. Okay, Jay Pawlowski at TVW is going to be sticking with us through the rest of this hour. Equity futures on the S&P 500 positive by a third of 1%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Turkish President Recep Tayyip Erdogan suffering a historic beat at the ballot box. The lira weakened in early trading after Erdogan's AK party fell behind the country's main opposition, the Republican People's Party, in municipal elections over the weekend. Support for Erdogan's ruling party is at the lowest on record as the nation battles rampant inflation and the highest borrowing costs since the president swept to power more than 2 decades ago. Salvage specialists are starting the daunting task of clearing debris from the destroyed Francis Scott Key Bridge in Baltimore. Ports along the U.S. East Coast are modifying their operations to absorb cargo diverted from Baltimore Harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. And UPS has announced an expansion of its partnership with the U.S. Postal Service. In a statement, UPS says after an initial transition period, it will become the primary air cargo provider for USPS. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, racing to reopen the Port of Baltimore.
That is the only way to get into most of the Port of Baltimore. And of course, it's important not just to the people and the workers of Baltimore, but to our national supply chains to get that port back up and running as quickly as possible.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equities doing okay to kick off Q2. Equity futures positive here by a third of 1% on the S&P 500. On a 10-year, just about unchanged, 420.63. Under surveillance this morning, racing to reopen the Port of Baltimore.
That is the only way to get into most of the Port of Baltimore. And of course, it's important not just to the people and the workers of Baltimore, but to our national supply chains to get that port back up and running as quickly as possible. Then you have the process of getting the bridge back up. That's going to take longer, but that work is already getting underway.
It's the latest this morning. Baltimore's mayor announcing plans to establish a temporary channel for commercially essential vessels to access the port of Baltimore, as other ports along the East Coast scramble to modify operations and absorb cargo diverted from the city following the collapse of the Francis Scott Key Bridge. Joining us now to discuss is Lee Klasko, the senior logistics analyst for Bloomberg Intelligence. Lee, can you talk to us about how easy it is just to redistribute some of that cargo that was meant for that port and to take it elsewhere?
Yeah, the good news is that the Port of Baltimore it's a large port, obviously, but it's not one of the largest ones in the United States. It's a big player in export coal, and some of that coal could go to the Port of Norfolk. And then it does a lot of business with what's called roll-on and roll-off. So think automobiles, ag equipment, construction equipment. It's specifically stronger in the ag and construction machinery equipment. So that stuff will probably have to move to Philly or maybe New Jersey or Norfolk as well. So you're going to see those types of products be moved. And on an intermodal basis or containers coming in, it's really not a major container port. It is one of the, maybe I think it's number 11 or 10. Obviously, it is big, but that can get easily absorbed in the Port of New York or Philly or somewhere else. And again, this is going to be a short-term kind of disturbance until the channel is clear. It's really unknown how long that's going to take. We've seen estimates between 6 and 12 weeks. I'm a little bit of a pessimist, so it's maybe north of 12 weeks for that to happen. And once that happens, freight's going to return, and the impact's going to be felt on supply chains, but it's not going to be a major blow like we were dealing with during the pandemic, or even what's going on. It's going to be less of an impact of what we're seeing from the Suez Canal and the Red Sea crisis that's going on with the Houthi rebels.
This temporary alternative channel on the northeast side of the main channel that we're hearing from the captain of the port, and this is what they want to try to establish. They talk about that this will be for commercially essential vessels. What does that mean exactly? What is deemed essential?
Something that's a fantastic question. I don't know the answer to that. I would imagine it is products such as healthcare products and things that we need, not things that we want. But I don't know how they would find those needles in the haystack of a container ship carrying 8,000 TEU. So it might be very hard for them to do that. I think what they're going to do is just try to find some priority for some freight that needs to get in and out of the port more on an expedited basis. But I think it remains to be seen about what that actually means or entails.
Hey, Lee, Jay Pulaski here. How much do you think the focus on getting the port up and running plays off of the ability of Pennsylvania, I believe, and Governor Shapiro to reopen 95 in such a quick period of time? It seems to me like U.S. government officials are much more focused on being able to use these crises as demonstrations of ability to get things done rather than huge problems that are going to take forever to fix. Is that your sense as well?
Yeah, I mean, listen, in a time when we can ever get things done is a great thing. Unfortunately, this is a reaction rather than something being proactive. The highway that stretched along the Francis Scott Bridge had something like 33,000 cars or vehicles on it every day. It's kind of small relative to I-95 or the BW Parkway. Those highways are going to see more traffic. It's not going to really impact that much truck traffic per se in terms of those trucks having to go to different routes, because at the end of the day, the port's going to be closed for a while. So the impact on those on highways is probably not going to be that meaningful. It's obviously going to impact the people that use the bridge every day more so than, call it, truck traffic.
Lee, we're catching up with you more and more. The conversation started in the last few months about Houthi rebels attaching commercial shipping vessels in the Red Sea. Then the conversation shifted to the water levels in the Panama Canal. Where are freight rates? Because freight rates started to pick up, and there was a sense, and we talked about it, that maybe that was temporary. Has it been temporary?
Yeah, so our big thesis has been that, these dislocations are short-term in nature, and a lot of them are create really knee-jerk reactions to rates. So, Trans-Pacific rates are down about 50% from last year. Transatlantic rates are up around 100% from last year. The transatlantic rates were just really off of weak levels. What we're seeing on the Trans-Pacific side, they peaked back during the pandemic, and it's been a slow reversion to the mean. The reality is supply-demand dynamics are not favorable to shipping rates. There's a lot of supply coming onto the market. The order book is very large relative to demand. And so, we should see continued deflationary pressures as it relates to the liner rates. Now, when you're looking at the truckload rates, this is a totally different market. But, spot rates right now are very depressed, and they're pretty much poised to kind of rebound, but we're still bouncing along the bottom. We expect spot rates to kind of start inching up higher with a little more meaningful direction sometime here in the second quarter. And so that should be good for trucking companies like the Warners, Knight-Swifts, and Schneiders of the world.
Lee, this was awesome. Good to touch base with you. Lee Klasko there of Bloomberg Intelligence. We reflected on this last week. Is everything just super fragile, or do bad things just keep happening more often?
Well, it feels like things are fragile and bad things are happening at a short period of time. What I find interesting is that a lot of these ports had peak capacity during COVID, and they started to lessen that back, so they can absorb some of these shocks we're seeing like we are in Baltimore.
Coming up on this program, we'll continue some of this conversation. Axios reporting the US and Israel will meet virtually today as Prime Minister Benjamin Netanyahu vows to press on in Rafah. Norman Rule, the former senior US intelligence official, joins us next. Live from New York City, this is Bloomberg.
I think I was around so many powerful people my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So Q1, double-digit gains on the S&P 500, more than 10%. Let's just say that was largely unexpected. Q2 kicking off things this morning. Equity futures positive, 0.25% on the S&P, up 1/3% on the NASDAQ. The NASDAQ 100 in March did basically nothing. I don't think enough is talked about that. And Jay Pawlowski, you've mentioned it. The action happening elsewhere, energy, the banks, not on the NASDAQ 100.
Yep, absolutely right, John. And I think it's the way the market is moving, right? People are looking for opportunities, and things get exploited so quickly these days, right? It's like, boom, everybody gloms onto something, and it pops. Like, I mean, it was tech. Right? In our global multi-asset model, the things that worked over the last month or so, it's copper and it's energy. Our copper miners are up almost 20%. Copper. Right? So it's that type of marketplace where things go from point A to point B.
I'll do something I don't normally do. I'm just going to skip the bonds board and go straight to the commodities board. And we can look at copper, crude, and gold. So copper right now is right through 8K, very close to 9. I want to talk about gold. What do you think is happening with gold as we look at another all-time high this morning, and gold is up by 0.9%? What's underpinning that? What's happening there?
Yeah, no, definitely gold is breaking out, and it's just a symbol that multiple parts of the commodity complex are breaking out at the same time, suggesting it's a really strong move. People are under-allocated. You have supply-demand issues taking place. And I think for gold in particular, what's interesting is that the biggest buyers of gold, John, are other central banks. Okay, so this is another example, I think, of the U.S. kind of sanctions policy maybe shooting itself in the foot a little bit. You already see a little bit of dollar erosion, and that's a longer-term story. People want to be reserves in other things. You see every day talk about taking Russian assets and using them to rebuild Ukraine. Maybe a good policy move, but it makes other central banks and reserve managers think about how much do they want to have exposed there.
You said the Fed story wasn't particularly relevant, or rather, wasn't relevant at all to your equity market call. How relevant is it to this? Because there is a sense in some quarters. We had Mohammed Al-Erin around the table with us following the Fed decision, and Mohammed was talking about maybe this Fed accepting a higher inflation rate, going beyond just a 2.0. Do you think that's starting to be baked into the commodity price as well?
Well, I think for gold, it's really rates, right? And so the fact that we've got the peak, we're likely to have rate cuts, that opens the door for gold to start to move. One of the things that we're waiting to see is for the dollar to roll over, and then that gives commodities another leg and gives other parts of the world, like emerging markets, which we like a lot, an opportunity to start to move as well. So that's the second part of the story. Gold is moving first, partly because of central bank ownership, partly because we are giving rate cuts. The rate cut cycle that we anticipate this year, John, will be the most synchronized since 2008. 10 of the 11 major central banks in the world are going to cut. The Swiss National Bank just started the G10 last week. So that door opens, that gold is an opportunity to move higher.
Guessing that one of the 11 is the BOJ,
yes,
right?
Yeah.
Which will maybe hike rates later this year, perhaps. That currency pair, dollar-yen, looking earlier this morning, has done virtually nothing all morning. Gold right now on my screen, positive by about 0.9%. Under surveillance this morning, no shortage of Fed speak this week. Fed officials currently slated to speak at a total of 19 events. The headline will be comments from Chairman Powell on Wednesday after he reiterated that the central bank isn't in any rush to cut rates anytime soon. On the data front, plenty of insight into the labour market this week. JOLTS and ADP reports coming ahead of payrolls on Friday. The Fed speak, AMH, you're going to hear from Williams, Mester, Daly, Goolsbee, Powell, Harker, Barkin, Goolsbee, Mester again. The list goes on and on and on through the week.
Yeah, and how much does it matter given the fact that we already heard from Powell after PCE, and we're going to hear from before jobs? I wish actually he was speaking Friday yet again after the jobs report, because that's really what the market is going to be building up to this entire week. And our survey is expecting 200,000. And then, of course, next week, inflation, which Lori Calvasino says really that's more important.
I'm not even going to ask Jay what he thinks about the Federal Reserve. I'll just go to the next story. Tesla shares shares higher this morning after the company revealed price hikes on Model Y cars. All three of its Model Y variants are now $1,000 more expensive. The company's website displayed the higher prices for the model in both the United States and China, with moves in China particularly significant as it runs counter to a number of incentives and price cuts EV makers in the country are offering. This was flagged before. I imagine, Jay, it was to encourage people to buy it ahead of the price increase. The competition here, though, is fierce. I shared some of this a little bit earlier. I think it's worth going over again. NIO's come out and announced a plan today that provides for up to $138 million of incentives for drivers of gasoline cars to make a switch. Another Chinese automobile company, Chery Automobile, came out and said it will cover the cost of purchase taxes on selected models, plus offered better trade-ins for customers' used cars as well. Can you think of a more competitive market right now than the Chinese auto market?
Well, what I love about that, John, is that they're communists. How does that even work? Communists are the best capitalists there are in China EV. It really is interesting. And to us, we named Tesla one of the first tripolar world companies a couple of years ago when they had production in Shanghai, production in Europe, production obviously here in the Americas. Now you see BYD doing the same thing, right? Production obviously in China, setting up a plant in Hungary, want to set up a plant in Mexico. And so this is the way the world is working. And Tesla BYD is really an interesting fight to see who is going to work, who's going to be successful. And Emery, to your point about, we were discussing earlier about China and China's ability to kind of compete in a block, you know, BYD is like the leading edge, right? So if BYD is doing fine in China against Tesla, in their competition, John, they are pricing at the same as an ICE car. So electric and ICE, same price. That's going to be a killer for basically the rest of the automakers around the world.
Look at the numbers this morning. They're doing more than just fine, and not just on EVs. To John, to your point, this hybrid push that actually a lot of people are looking at. When it comes to Tesla, though, this price hike, yes, it was flagged, but also it comes as they earlier this month told employees they're not going to produce as many. Remember, they went from a 6.5-day work week to a 5-day work week. Less cars, they have to pay for it somehow. Jack up some of the price.
Jay, you've pointed to a story that I think, though, is going to be incredibly complex in years to come. The difficulty of dominating three of those markets simultaneously. How hard is that going to be? Because we get the sense now that governments are basically determined not to allow BYD to succeed domestically. This isn't a push that's coming from manufacturers. If you speak to the car companies, at least this is what they say on the record, so you decide whether it's what they truly mean behind closed doors as well. On the record, they're willing to compete. What you hear from government officials is they're not going to let BYD compete in places like the United States. So when you think of your tripolar world, are there companies that can be successful across three different regions simultaneously?
Yeah, that's going to be the challenge, and I think the best companies are going to be those companies that are able to do that, and BYD is a great example. So they are already thinking that maybe they're not going to be able to put a plant in the United States. So they've licensed their battery technology to Ford. So they are participating through Ford. They hope to be able to put a plant in Mexico and export into the United States. And I think the challenge is going to be the driver is the climate. And we need to deal with climate, and we need to hit our numbers on the climate. The Chinese have dominated the renewable product line, whether it's solar, whether it's wind, whether it's EV, whether it's battery. And so how do you square that? You know, we need to do this many EVs in order to hit our carbon neutral targets. The best, cheapest EVs are Chinese, and therefore, what do? I think that is a policy question, but to us, the reality is that the world is moving in this tripolar process, and these companies are the ones who are really leading the charge.
One to watch. It's a big story this year, that's for sure. Let's turn to our next story. The US and Israel set to meet virtually today to discuss the Biden administration's alternative proposals to an invasion of Rafah, according to reporting from Axios. The meeting following comments from Israeli Prime Minister Benjamin Netanyahu saying they're preparing to move more than 1 million Palestinian civilians out of Rafah before launching an attack on the southern Gaza city. Joining us now to discuss is Norman Rule, Senior Advisor on the Transnational Threats Project at CSIS, and a former senior US intelligence official. Norman, can you talk to us about alternatives? This conversation is an important one. What do you suspect the alternatives are?
Good morning. Well, first, the nature of the talks themselves tell you something about the alternatives. These are not direct military to military conversations. This is an interagency team led by the National Security Advisor, so this is not tactical operations. Second, as you look at the Rafah target itself from the Israeli perspective, they don't need to work in the tent areas. They need to focus on the inner city where the tunnels are located and Hamas leadership and the remaining 4 battalions are located. So the question becomes, how do you move portions of the population to open up areas of the city, likely in a staged progression, to allow Israeli forces to come in and achieve that mission? The challenge, of course, is that Hamas's primary defense is to fight from behind civilians because civilian casualties produce international political pressure that restrains Israel.
This meeting today is not tactical. Is it just political? And in that sense, has the pressure the Biden administration has been putting on Netanyahu, has any of it worked to materialize?
Taking a look at the market wrap, the statistics from last week on declining inflation increased expectations that the Federal Reserve will lower interest rates this year, which led to a rise in US stock futures and an all-time high in gold. While markets were closed for Easter in Europe, Australia and Hong Kong, S&P 500 contracts climbed 0.4%. Pre-market gains by Nvidia, Advanced Micro Devices and Microsoft signaled a robust opening for tech companies. Monday saw the price of gold surpass $2,265 an ounce, up 1.4% from Thursday's closing, while the dollar index continued to decline. Bitcoin dropped to less than $70,000. The Fed's preferred measure of underlying inflation began to decline this month, and this, along with the increase in household spending, implies that the bullish narrative that drove stocks to record highs this year is still in place. With the volatile food and energy components removed, the so-called core personal consumption expenditures price index increased by 0.3% in January, but slowed down in February.
And if married with precision technology, can be used in a way to minimize civilian casualties. Israel needs this. The Biden administration can slow these deliveries. And Israel also needs this to work against Iranian operations in Syria and Lebanese Hezbollah. So it is unlikely the U.S. is going to cut aid, but the U.S. can constrain that aid, which shapes Israel's operational capabilities.
If we're looking at future aid, though, going to Israel and potentially some of these constraints, do you think this administration would sign off on what some progressives in their own party want, which is strings attached to some of those weapons going to Israel?
It's unlikely only because of the complexity of that statement. For example, if the strings attached are that Israel withdraws from Gaza, then we have to recognize that Hamas not only wins, will take charge of Gaza, will push out the Palestinian Authority, and that leaves, again, a Hamas state in Gaza, possibly within the West Bank itself, on the border of Jordan, which is a somewhat fragile state. So the United States has a complex geopolitical dynamic in which it must engage, but its concerns over civilian losses are genuine.
The president appears to have set a red line. I say appears because he still has the luxury of backing away from that if he wants to. Norman, what do you think the consequences actually are if Israel crosses that perceived red line? What are they? What does the US do? What kind of change in policy would it generate?
I think the idea of a red line is difficult to understand because the U.S. does support operations against Hamas, does support Israel eradicating Hamas. It's just how that's done. So as long as Israel doesn't conduct an operation that results in massive civilian casualties, that appears to be consistent with U.S. policy. If Israel does cross that line, I think you would see a large pause in aid. We saw in 1991 a significant dispute between the Bush administration and the Israeli government over a $10 billion aid package, and that aid was withheld at the time until the then Israeli government made concessions. I think you might see something like that in the future. In any case, the U.S.-Israeli relationship has been really challenged and even stained by this event, and will take some time to recover.
Certainly strained over the last few weeks, even more so. Norman, wonderful to get your perspective, as always, on this story. Norman Rule there of CSIS. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. OpenAI is expanding its global footprint. The artificial intelligence pioneer is set to open an office in Tokyo, according to sources. It will be the company's first location in Asia and third international office overall after opening branches in London and Dublin last year. The ChatGPT maker maker has been in talks to raise funding at a valuation of at least $100 billion. A big data breach at AT&T is affecting more than 70 million current and former customers. The telecom company says the data leaked on the dark web and includes personal information such as social security numbers. AT&T says the source of the data is still being investigated, and it's not known whether it came from the company or a vendor. It's not the first issue this year for AT&T. Back in February, it experienced a widespread outage that took hours to resolve and is now being investigated by the federal government. In the March Madness tournament, the North Carolina State men's team continuing their shocking run with a win over Duke Sunday night. The 76-64 victory has the 11th-seeded Wolfpack back in the Final Four for the first time since it won the national championship back in 1983. And in the women's tournament, college superstars Caitlin Clark of Iowa and Angel Reese of LSU facing off tonight in a rematch of last year's national championship game. That's your Bloomberg Brief. John?
Yahara, thank you. This is where the man from Duke says he doesn't care about basketball. Is that right?
More than I do about the Fed, John. Definitely a disappointing outcome, but I'm really focused on Duke football. So,
of course,
best of luck to the hoopsters. But
I knew that.
We're football focused here.
I have to do this every year just for my own evaluation, given where my manager went to school. Boiler up. I think we do that every single year. Boiler up. Final Four. Final Four. I was messaging Rachel yesterday. I was like, semi-finals. She was like, no, it's called the Final Four. It's not the semi-finals. So I'm adjusting. Up next on the program, Chair Powell sticking to script.
Growth is strong right now. The labor market is strong right now. And inflation has been coming down. We can and we will be careful about this decision because we can be.
That conversation up next. Jay's going to find a way to weigh in on the Fed Speak. Live from New York, this is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Equities on the S&P, silence around the table. Futures positive, a third of 1%. So excited about sport and baseball and Massachusetts, apparently. Equity futures on the S&P right now, positive a third of 1%. Yield just about unchanged. 420.82. Under surveillance this morning, for some of us at least. Chairman Powell sticking to script.
We don't see it as likely to be appropriate that we would begin to reduce interest rates until the committee is confident that inflation is moving down to 2% on a sustained basis. But if that doesn't happen, then obviously our rate policy will be different. We can hold rates where they are for longer. Growth is strong right now. The labor market is strong right now. And inflation has been coming down. We can and we will be careful about this decision because we can be.
Here's the latest this morning. Friday's inflation data coming in line with the Fed's expectations, keeping the central bank on track to start cutting interest rates in June. Ed Al-Husseini of Columbia Threadneedle writing this: I suspect we are underpricing how much easing is likely to be necessary in 2025 to offset the normalization this year. But I'd like to see front-end yields overshoot more to the upside. I like owning long-end bonds with this backdrop. Ed, I'm pleased to say, is with us around the table. Ed, good morning to you.
Good morning.
Before we get into the yield curve, there's another quote I want to use of yours, and it's on the framing of the Federal Reserve's policy. I think this is really, really important. It's a framework question. Here's the quote. As the Fed moved from looking for real rate settings consistent with inflation declining towards 2% to making rate normalization contingent on signs of economic deterioration, how would you answer your own question?
Yeah, not yet. I think the focus remains firmly on inflation, and the judgment, and we saw Chairman Powell reiterate that last week, is that monetary policy settings are in a good place. Once we start focusing on unemployment and the lack of an increase in unemployment, the bar for starting those rate cuts starts to go up significantly higher, and we're not quite there yet.
Labour market on Friday, payroll's just around the corner, CPI next week. Given what you've just said, is CPI still the bigger number versus payrolls on Friday?
Most definitely. Most definitely.
And it's going to be for the time being, for the next few months, next quarter?
I think that's right. And this is the struggle the Fed's having at the moment, is they're so focused on short-term data, and disproportionately at the moment it's short-term inflation data. It highlights a couple of things. One, there isn't really a great framework for forecasting inflation in this environment. We're feeling our way out in the dark, and that's what the Fed's reiterated a number of times for us. Second, are real rates in the right place? And this is kind of the core question. Are monetary policy settings okay, or are they being eroded by the fact that markets are doing really well and financial conditions have eased? They're shying away from that later question and really just myopically focusing on short-term inflation data.
Ed, I got two questions for you. One, if you look at the Fed funds rate versus the core PCE, one could argue that monetary policy is super tight. Tightest since 2007. We know what happened at that point in time. I'd love your thoughts there. And then the second question, at our firm, we're bullish on commodities. And I know you like the long end of the curve. Do you have a commodity view built into that? Like if commodities go up 10 or 15%, broadly speaking, does that make your long end buy recommendation less attractive?
Yeah, let me work backwards. I think commodity space is really interesting at the moment, largely because growth has surprised to the upside so consistently over the course of the past year and a half, right? I don't remember the last time we had negative growth surprises. I think it was 2022, maybe perhaps the middle of 2022, when surprises were negative. And if you look at just the span of the last 6 months, growth expectations for the U.S. have doubled, right? I think the Bloomberg survey has gone up from below 1 to in excess of 2%. This is a fantastic backdrop for the commodity space, and a lot of this recovery has been led globally by manufacturing stabilizing and now potentially accelerating, and we saw that with PMI data coming out of China over the weekend. So a pretty decent backdrop for commodities. I think where it starts to disconnect a little bit from the Fed strategies, that those commodity prices really have not fed into underlying inflation in a meaningful way, right? Oil prices are back up to close to 12-month highs at the moment, and yet inflation has continued to systematically decline. We're now in sort of the 2.5–3% space, so we're squeezing out that last bit. So I think fantastic space for commodities. Remind me your first question.
Yeah, just the spread between Fed funds and core PCE, real money, very tight, or real rates.
The question is, what's the benchmark for that, right? And this is where we get into the sort of the neutral rate conversation for the Fed. What's the rate that the economy can sustain? And it clearly looks like that rate's drifted higher, at least relative to where we were pre-COVID.
So that raises questions about the limits of potential easing further down the road. You mentioned that in 2025. We heard from Andrew Bowles at PIMCO at the FT last week, and he likes duration also, but maybe looking at the longer end abroad, outside the United States. Two reasons: one, supply, another one was the limits of easing here relative to what you might get from elsewhere, the ECB, etc. How would you think about that, the US versus what's happening abroad?
Yeah, I would say, I mean, the key differentiator here is really the domestic growth story here in the U.S. We're large, relatively closed economy. We've not been impacted to the same extent by, let's say, the energy price shock in 22. And the strength of the dollar is disproportionately negative for those economies. And that we've seen that in the manufacturing story in Europe. Where I think it gets more interesting is the judgment call of whether we can continue to surprise growth to the upside, right? This gets into the productivity story. Has something in the economy reshuffled in such a way that we can grow faster post-COVID? My bet is fundamentally not likely, and therefore some of the growth that we've brought forward in the course of the last couple of years is likely to leak out of the system and give us room to cut. And I think duration here in the U.S., again, in part because the starting real rate's a little bit more attractive.
Jay, do you take the other side of that?
No, I like that because I think that extends the story, right? We talked earlier, we have a view that the 2023 to 2027 period is akin to the 95 to 99 period in the U.S., where we have several years of solid economic activity ahead of us. And what I'm hearing you say is that we're set up such that rates can be cut in 2025. And I think that backdrop just kind of reinforces a pretty positive outlook, John, and probably reinforces the non-U.S. play because that should lead to dollar weakness. I guess that would be my next question for you. You know, what's the view of the dollar here, given your expectations? Because our view is that that's going to be the second leg for the commodity kick, the second leg for EM, et cetera.
Meaningful dollar weakness, in my mind, really begins with an aggressive rate easing cycle, right? Some of the mid-cycle adjustments that we're currently pricing for this year anyway, let's call it 2 cuts or so, probably not going to do it. We're going to need to do a little bit more. The outlier event that tends to backstop the dollar is a risk-off environment, right? That is very, very difficult to predict. You know, risk asset valuations right now are a little bit on the rich side. Yeah, what knocks that off course? I have no idea, right? We might have to wait for that a little longer.
Ed, this was super thoughtful stuff. It's good to catch up with you.
Thank you,
sir.
Thanks for
Ed
having me.
Ahosani there of Columbia Threadneedle, together with Jay Pilosky at TPW. Jay, thank you, buddy, for the last hour. Enjoyed this.
Always a pleasure.
We'll keep doing
Thank
this
you. Yeah?
every single month.
Love it.
Equity futures right now on the S&P 500 positive 0.25%. In the next hour on Bloomberg Surveillance, Peter Chair of Academy, former New York Fed President Bill Dudley, Greg Dacko of EY, and former Fed Vice Chair Randy Quiles. A whole lot more still to come. The third hour of Bloomberg Surveillance up next.
Do you feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up, quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that. I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we presented with a plan.
Secured overnight financing rate 5.34% for March the 28th versus 5.33% for March the 27th.
Great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
I think the Fed needs to be market-based and not academic-based.
I think they need to cut before they risk staying higher for too long.
We expect data that will be forthcoming to give them confidence. And it is the Fed's job to take the data pretty much at face value.
The best thing is to just be able to truly look at the data and stand by that, because no matter what they do, they're going to get criticized on the timing.
I'm really not as concerned about.
So good morning traders, and welcome to the US session now on Financial Juice. It is Monday the 1st of April, so happy Easter Monday and of course April Fool's Day. So here's what to look out for today's session. So US inflation data Friday and Jerome Powell's speech did little to alter the outlook for interest rates, with market odds still favouring a cut in June. Powell reiterated that the US central bank is not in a rush to decrease interest rates, while policymakers await additional proof that inflation is under control. So European and US equity futures climbed today as US inflation data did nothing to change the expectations that the Federal Reserve will lower rates this year. So the yen remained near the 152 per dollar mark, a carefully watched level that some traders believe could prompt an intervention from the government. Japan's finance minister stated that the government is closely following currency developments and will take appropriate action to prevent any excessive moves. Elsewhere, the dollar wavered in sparse holiday trading as major European and Asian markets were closed for Easter Monday. So taking a look at the docket for today's session, at 9:30 a.m. Eastern Time, we do get Canadian manufacturing PMI. At 9:45 a.m. Eastern Time, we get the US S&P manufacturing PMI, and at 10 a.m. Eastern Time, we get the US ISM manufacturing PMI, ISM manufacturing prices paid, construction spending month over month, ISM manufacturing new orders, and ISM manufacturing employment index. And at 11:30 a.m. Eastern Time, we do get the 3- and 6-month bill auction, the US selling at $70 billion of each. So good luck today, traders.
About the Mag 7, Fab 4, or whatever. His words, not mine. And that it is time. At the time of the 22nd all-time high for the S&P 500, I'm looking for anything to steer me away from that. The Russell 2000
Effective Fed funds rate 5.33% for March 29th, unchanged from March 28th. So Treasury yields extend their climb. 10-year yield rises to 4.25%. US natural gas futures extend gains, prices up by 5%.
contract that Fed more than 2 decades, but now will go to UPS once that existing contract expires September 29th. FedEx, of course, taking a beating on this news. And finally, AT&T grappling with a data leak. Personal data from about 7.6 million current account holders and 65.4 million former customers appears to have been leaked to the dark web. It was leaked about 2 weeks ago, and the company is resetting millions of customer passwords. Manus.
Okay, that is a bit of a breach. Simone, thank you very much. Coming up, signs of momentum emerging in China.
Now people are just starting to think about China. You're talking about second biggest economy in the world, looking like it's starting to pick up.
We'll dig into that strong data in just a moment on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Now people are just starting to think about China. Okay, PMI is better than expected. JP Morgan last week raised their Q1 GDP estimate to 6.6%. Okay, so you're talking about second biggest economy in the world, looking like it's starting to pick up, and that is obviously bullish for lots of things.
Suddenly upbeat China data fuels the economic recovery hopes. Manufacturing activity rebounds after 5 straight monthly declines. That boosts optimism the country could hit its ambitious growth target of 5% for 2024. Ed Curran is with me to discuss the conundrum. They've tinkered with policy, but not in the traditional ways that they did post-GFC. And so my question to you is, the policy response mechanism you've seen so far from China, it is bearing fruit?
Well, certainly on the industrial side of things, Manus, it does look like there is traction there. As you just mentioned, both the official and the Caixin PMI indicator, both now in positive territory. That suggests that the broader export upswing is helping inflate the industrial side of things. Within the PMI readings, there was a better reading for new export orders as well. So it looks like the industrial side is gaining traction. Those results came in better than expected, and it does add weight to the idea that China's gotten off to a better start on the export and trade side of things as well. Now, of course, the consumer story remains sluggish. They have yet to really rev up the real estate side of things, but at least when it comes to putting a focus on manufacturing and industrial production, that does seem to be, so far at least, a bright spot in China's recovery.
What is their tolerance for a lower yuan? What role will the currency play in hitting this 5% target?
Well, there's no doubt the cheaper currency at the margins, I would say, helps exporters. It's certainly plenty of economists who question how much dividend it really does offer, but at the margins it helps them. But for China, it's always about the pace of decline, it's the volatility in the yuan, and that's what concerns them the most, and that's what they'll be watching closely. But as you say, Manus, there is a very aggressive growth target for this year. That 5% figure, that's a political target, don't forget, which suggests that the government and the authorities will have to meet it. And that's why a lot of economists are saying more spending is coming down the tracks. We are seeing banks upgrading their forecast, like Citigroup last week as well, upgrading their forecast for China. So, of course, there is weakness, as I say, in consumer and real estate, but people are broadly saying this year should still be a stronger year for China's economy than last year.
Okay, and thank you very much, Enda Curran, on the very latest Caixin and PMI from China. Michael Collins, Catherine Avery are my guests this morning. Oftentimes we talk about putting in a floor, and as Enda just said, the political aspiration of a 5% growth target. But when I look at China and you look at the outflows, the capital outflows, along with the equity market disinvestment narrative, Catherine, to you, when you see this kind of base forming in growth, what does it do for the China playing into the global narrative and back here to the US?
Well, the Chinese are looking for some way to stimulate their economy, and I think that they're finally going to get it. And I think that's going to have a great impact on the economies around the world. Again, we're going to start to see an uptick in commodity prices probably from this. We've had oil already increase 15% so far this year. It could possibly even go higher. The question is, what does that do to our inflation numbers here, and how does the Fed react to that? And how, if the Fed, or not react to it on the other hand, and then what do markets do in return with that? But I think all in all, I think it's going to have a positive impact on what we see here, not just on the economy side, but also for corporate profits.
Okay, I mean, that's on the equity side. Michael, to you on the fixed income side, we're going to see this potentially syncopated rate cutting narrative around the world. It may well be Bank of England, ECB, and Fed, perhaps the trifecta going a little bit more syncopation. But when you look at the Chinese story, we haven't seen the massive rate cuts that we traditionally had associated with stimulus economy. How do you look at this floor creation, let's say, in the economic cycle for China?
Yeah, they've been going against the tide from a monetary policy perspective, really, for the last couple of years. Almost
in 10 minutes' time now, we do get the Canadian manufacturing PMI, prior at 49.7.
Generally been cutting rates. I mean, their 10-year yield is a full 200 basis points lower than ours. In fact, we've recently cut positions in Chinese debt because of the low level of interest rates over there. So, they've been trying to stimulate. To some extent, though, it's been pushing on a string a little bit. I mean, the fundamental backdrop in the economy with the real estate overhang, a weak employment picture, deflation, right? I mean, there's good GDP and there's bad GDP. Yeah, the numbers are picking up, but they're making more things and selling them at lower prices to the rest of the world. Even their input prices are coming down. The people are actually increasingly trying to get their money out. I think they've lost confidence to some extent. They've lost money in the stock market. They've lost money in all the real estate investments. And our hearts go out, to the Chinese people. It's a really tough environment. So I think you have to be a little wary of some of these headline figures and look through that. The good news is if it's painting a more global disinflationary backdrop, that does allow the Fed to ultimately cut rates.
So if you trim back, Michael, on your China exposure in fixed income, you see the Bank of Japan gearing up into action. I'm just curious, if you scale back or trim back in China, where have you redeployed on a global basis to?
Yeah, we're basically, flat or even a little bit short interest rate risk in general. Man, it's like even in the U.S., like I said, I think the rate cuts that are priced in the next year or so might be a little too optimistic. So just, I think, similar to the credit markets, I know it sounds like, sitting on the fence, but really waiting for better entry points in the rate structure before we get long duration. So it's been, one of these worlds where you take profits when things rally a lot, whether it's different rate structures like Chinese rates or credit spreads, and you just earn your carry and you play a little defense until you get a better opportunity. And the same is true in the global rate structure.
Catherine, what would be your line of defense if I said to you, I know that you got some cracking tech names in there, IBM has done well, etc. But if there was a defensive
So just taking a look at the
briefly,
markets in pre-trading here, so the S&P 500 up around 0.09%, and the Dixie around 0.09% as well.
Michael Collins, Catherine Avery setting the agenda this Monday morning. Coming up, your morning calls, and a little bit later, Citigroup's Stuart Kaiser joins me with his outlook for stocks after logging their best first quarter since 2019. The conversation right ahead on Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built
in 5 minutes time now at 9:30 a.m. Eastern time, we do get the Canadian manufacturing PMI prior read 49.7.
Global markets. The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Don't miss Bloomberg's interview with the
Start the second quarter with a nice bid. Inflation's well behaved. Catherine Avery just with us there now, telling us to ride that cyclicality. And in terms of what Wall Street analysts are saying, this is what we've got for you. Time for your morning calls on this street. First up, Morgan Stanley naming Delta as its top pick in the airline space, pointing to a strengthening in demand and a compelling valuation. Next up, Bank of America raises Micron's price target to $120, expecting the shares to benefit from surging AI demand. And Wells Fargo adds Tesla to their tactical ideas list and keeps an underweight rating on the shares. The firm sees moderating growth, slower demand, and diminishing returns for the EV. Coming up in the show, Citigroup's Stuart Kaiser joins me around the rally. The best first quarter since 2019. Does that endure, or do you want moments of moderation in your portfolio? That's next on Bloomberg.
traditional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials.
1 minute remaining till we get the Canadian manufacturing PMI.
Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Ten seconds.
You had a pretty bullish first quarter, the best since 2019 across these markets. We start bid up. Parts of Citi have a new underweight on technology. We'll catch up with Stuart
49 spots 8, 49 spots 8. And taking a look at the market on open imbalance, 5 million to the sell side.
As for the rest of your assets, we've got a unanimously bullish call from HSBC this morning on Bloomberg Brief, but this is how the rest of your assets stand. Records in gold. JP Morgan says it is their #1 pick in the commodities. 2,500 for 2024. China has been a buyer of gold. 10 years, yields rising ever so slightly there. We're up 5 base. It is beginning to tick higher. So this boon that we had from, let's say, the well-behaved PCE seems to be just waning. And crude oil up 0.2%. So you have oil marching higher in day one of the second quarter, up 14% in the first. One stock to watch, it is AT&T at the open, the wireless carrier, saying 73 million accounts leaked onto the dark web. This is quite a big breach. Simone, can you put some context around this for me?
Yeah, let me give you the timeline of events here as well. The company announcing this data leak on Saturday. TechCrunch, the publication, though, saying it alerted the telecom company to the leak back on Monday and then held off on publication of its story until the company was able to engage in a mass password reset. We understand that the leak includes information including social security numbers, home addresses, phone numbers, dates of birth. The company is saying that this data appears to be from 2019 or earlier, but it did appear, this leak, on the web about 2 weeks ago. So far, AT&T is saying it launched a robust investigation supported by internal and external cybersecurity experts. It says there is no evidence that there was unauthorized access to its data, and it's saying that it will provide credit monitoring at the company's expense where appropriate. But bad news for AT&T, which was already grappling with a federal investigation into a widespread outage that had happened in February. We're watching shares off over 2% in early trading, Menace.
Okay, Simone, thank you very much. Turn our attention to the banks. We've had some guests who want to be long of these banks into this market. Analysts expect big gains from Citigroup this quarter. Wells Fargo adds shares to their second quarter tactical ideas list. Goldman adding the stock to their conviction buy list. Katie Greifeld is here. Katie, big calls.
Big calls, yeah. Citi getting a lot of love from the sell side today. Let's start with Goldman adding the bank to its conviction list for April. And then you have Wells Fargo adding Citi to its second quarter tactical ideas list. So the analyst's logic there is that Citi is embarking on a multi-year inflection, which should see better efficiency and returns. They have an overweight rating, of course, and a 12-month price target of about $80. You can see shares currently trading around 63.5 right now. So Wells Fargo and Goldman Sachs, they are two voices singing in the bullish chorus for Citigroup. If you actually take a look at the total sell side, Citi has 0 sell recommendations among the 26 analysts tracked by Bloomberg who follow the stock, and for good reason. You take a look at the performance lately. Shares are up 24% so far in 2024. That compares to just about 10% for the S&P 500. So some massive outperformance there, of course, amid Jane Fraser's turnaround efforts.
Okay, Katie, thank you very much. Let's focus in on the EV story now. Nikola is extending its rally into a 9th session. This is the longest streak on record. Tesla shares, however, under pressure ahead of a looming delivery numbers. Ed is with us. He's in New York for the week. Ed, good to see you this morning. So we're counting down to the numbers, the delivery numbers from Tesla. But talk me through the Nikola.
Yeah, I mean, Nikola is a company we talk about less. I'm micro-focused on it, obviously, given my history of reporting on that company. 9 straight days of gains is the most on record, but I won't say it's a catalyst. The news story is that Nikola's board and management are suing the founder and CEO, Trevor Milton, who you remember was sentenced to 4 years in prison in December for securities fraud. Trevor Milton had been trying through a proxy battle to install some allies of his onto the board, and what Nikola is saying in the suit is it's not illegal to attempt a corporate hostile takeover, generally speaking, but in this case it is, because they feel the candidates that Milton, who is appealing his sentencing, is putting forward aren't appropriate. So that's an interesting one. The stock actually pairing its early declines 4.8%. Tesla is interesting. It's down 0.6%. The average analyst estimate is that in the first quarter they delivered 453,964 vehicles. That would mean sequentially quarter on quarter a sales or delivery decline, but the key metric to look is against the same period a year ago where they delivered around 422,000 odd. We know the story in the quarter gone. Difficulty with high rates putting off the consumer, a broader global EV growth slowdown, and then they had supply problems, the pause at the Berlin plant, sources telling us
in 10 minutes time now at 9:45 a.m. Eastern time, we get the US S&P manufacturing PMI final forecast 52.5 on the prior 52.5 with a range of 52.8 to 52.3.
Just for the experience of doing it, but it was an incredible deal. Tesla normally does that. They really go aggressive at the end of the quarter to try and boost sales in the final days in a sprint finish.
And tell me then, did you put the order in?
I did. I picked it up last Thursday, and genuinely, I was looking for a vehicle. The leasing experience is very straightforward. I don't think that I, as one individual, will make a difference this quarter in the grand scheme of things, but it's a classic case or example of how they normally do things. Heavy incentives in the final few days, and then hope that they get that boost to try and exceed expectations when the final day of the month closes.
Okay, well done, Ed. The experience is everything. Ed Ludlow in New York for the week. Let's turn to big tech now. Microsoft is planning to sell its chat and video app called Teams separately from its Office product, just 6 months after it unbundled the two products. Now, this is according to Reuters. Alex Semenova is with me. This is a shift in strategy, Alex, isn't it?
Hey, Manis, good morning. Indeed it is. If you want Microsoft video chatting, if you want Microsoft emailing services, you're going to have to pay for these two products separately now. This move by the technology giant to unbundle the services is meant to avoid a potential fine from the European Union. This is according to a report from Reuters this morning. The EU, as well as businesses, including Slack, have argued that Microsoft has an unfair advantage by coupling these offerings. As a result, Microsoft will introduce a new version of its Microsoft 365 and Microsoft Office 365 subscription services, excluding Teams. This comes about 6 months after it uncoupled the products in Europe. Now it's doing so globally. Microsoft said in a statement that this directly addresses feedback from the EU. However, businesses, including Slack, which is of course owned by Salesforce, have argued that in the past, Microsoft has forced installation of Teams to customers through its market-dominant suite of products. products. They said that this was illegal. Shares are still moving higher this morning, up more than 1.5% today. And this comes, of course, after an incredible start to the year for Microsoft. The stock was up this year 12% through Friday's close, of course, slightly outperforming the S&P 500's 10% gain. Manis.
Alex, thank you very much. Microsoft is bid this morning. Let's just reprice the 10-year government bond yields. This is the move. As you can see, we're up 6 basis points, a slight steepening, re-steepening in the curve. Twos are up much less, up by 2 basis points. You've got good core PCE. You've got good core services, inflation being well behaved. But maybe the market just a little bit irked and repricing the first full cut to July as we were in a fully extend and pretend mode from Chairman Powell. Lots of Fed speak to get our teeth into. But 6 basis points higher at the moment on 10s. Citi Stuart Kaiser weighs in on the markets, writing this. Our core positive view on U.S. equity risk remains in place. Stronger nominal growth, lower unemployment, and less concern about the recent strong inflation prints, and the committee still leaning narrowly towards 3 cuts this year. Stuart, good to see you this morning. So at your core, you're positive. My question to you is, as you embark on the second quarter, do you expect the velocity of capital to be deployed into equities aggressively or tepidly? Good morning.
Hey, good morning, Matt. It's good to see you again. Look, as I mentioned, we do remain, pretty constructive on markets. Will the rate of, change be the same in the second quarter as it was in the first quarter? Probably pretty unlikely, right? It's hard to stack up, kind of 10% equity gains back to back. But, if you look historically, equities are kind of a momentum asset. So when they get moving in the right direction, they can, likely continue in that direction unless the facts change. And for us, the key there is the labor market. As long as employment remains strong, we think equities will do well, and we like, having that risk on.
Shall we have a fist fight within Citi? You've got one of your colleagues, Scott Croner. Big call here. Downgrading U.S. tech. The rally will broaden, and they've got a new underweight on tech. Are you as brave as that, or a little bit more judicious?
I'm definitely not that brave. No, look, I think the broadening call at large, we agree with, and Scott has had that view for an extended period of time as well. And frankly, you're seeing it, right? Those Mag 7 stocks were about 2/3 of market cap gains for the S&P in 2023. That number's down into the 40% range. So you are seeing a broadening out. I think our view is tech doesn't trade lower. You just start to kind of fill in around the edges, and you're starting to see earnings broaden out.
In 5 minutes' time at 9:45 a.m. Eastern, we have the US S&P manufacturing PMI final with a forecast of 52.5, a prior of 52.5, and a range of 52.8 to 52.3.
Contribution in the S&P, has broadened out a bit. So, definitely agree with the broadening theme. Obviously, tech is a really tricky trade here, just given how powerful it's been.
Indeed, and there is the Mag 7 today. Again, Tesla on the back foot along with Meta, but certainly Tesla has been one of the biggest underperformers. Can you everybody's sort of clamoring for the year of the bond, aren't they, Stuart? And here we are in the first quarter. Stocks had a roar, up 10%. You point out that bonds underperformed by 2%. I'm not even going to ask you whether you think it's going to be the year of the bond, but do you think that incrementally do we move to